You think you are buying an apartment. But in a Miami high-rise, the apartment may not be the biggest thing you are purchasing. Consider a two-bedroom condominium on the 18th floor, with water views, a little over 1,000 square feet, and an asking price in the mid-$400,000 range. The monthly condominium fee is roughly $1,300. At first, the equation looks simple: the apartment and the monthly fee. But what are you actually buying besides the apartment? Once the transaction closes, the buyer does not only receive the space behind the front door. The buyer also becomes connected to the building, the association, and every shared obligation that makes the property function. The apartment does not operate alone. It belongs to a condominium association that governs the shared parts of the property. That association manages three connected layers: shared spaces and building systems, money and insurance, and collective decisions recorded in budgets, contracts, studies, and board records. So the buyer is not simply purchasing an interior space with a view. The buyer is entering a system. The apartment is the visible asset. The association is the second asset. Unlike the apartment, that second asset cannot be understood from photographs, finishes, or a walkthrough. It has to be understood through records. The monthly fee matters. At roughly $1,300, it already adds about $15,600 a year, before property taxes, personal insurance, financing, or maintenance inside the unit. But the fee is not the same thing as the building's total obligation. It is only the amount being collected under today's association budget. Today's fee supports today's operations. The building still has a future. Systems age, insurance renews, inspections occur, projects are planned. The real question is whether the ownership system can remain supportable over the buyer's expected holding period. You are no longer evaluating a Miami apartment plus a monthly fee. You are evaluating entry into the ownership system of an entire high-rise. Buildings age, even when the apartment itself looks complete. Major components have limited useful lives. A reserve study estimates what the building may need, when that work may arrive, and how much preparation may be required. Florida's reserve framework requires qualifying associations to plan and fund for covered building needs under the applicable rules. Then the association has to decide how that future is paid for. Existing reserve contributions may be enough. If not, dues may rise, the association may borrow, or owners may face a special assessment. None of that proves this Miami building is underfunded or that an assessment is coming. The actual reserve balance, study conclusions, project timing, and funding plan still have to be verified. The apartment may require no immediate work, while the owner's cash requirement still changes through the building. A Florida milestone inspection evaluates an aging condominium building to determine whether substantial structural deterioration exists. The existence of an inspection requirement does not prove the building is defective. It tells the buyer where verification must begin. What did the engineer find? What work remains open? And how is any required work being funded? A document title may be a useful lead. It is not a conclusion. Until the underlying files are obtained, authenticated, and read, the buyer cannot know whether they reveal a problem or routine planning. Once a building obligation is identified, the next question is how it reaches the owner. Existing reserves may absorb the cost. If they do not, regular dues may rise, the association may borrow, or the board may approve a special assessment. The buyer may need more cash now or face higher payments later. Either outcome can change the effective acquisition cost and reduce financial flexibility over the holding period. The common element belongs to the building. The financial consequence can reach every affected owner. A condominium building can have a master policy, and owners can still retain meaningful exposure. The practical question is what happens after the policy responds. 3 checks provide the clearest starting point: the deductible, what the policy excludes, and who bears the remaining cost. Those are not the only legally relevant materials. The policy and governing documents still control how responsibility is allocated. A covered event can still leave a residual cost. That amount may become a common expense, an association obligation, or an owner responsibility, depending on the facts and documents. There is no verified evidence that this Miami building has a coverage gap. After the master policy responds, what risk is still retained by the association and by the apartment owner. This investigation matters only if it changes what the buyer does before closing. The package may include governing documents, financial statements, the current budget, the latest reserve study, inspection summary, and board records. What obligations already belong to the association and the building? How are those obligations currently funded, insured, and governed? What additional contribution, restriction, or disruption could reach the owner after closing? The documents have to be read as one coordinated evidence package. Compare the budget with the reserve study and inspection findings with repair and completion records. Compare the master policy with the declaration and owner's coverage, and board minutes with the purchase decision. The documents do not automatically reveal a problem. They reveal the ownership system the buyer is being asked to join. The Miami apartment may still be an attractive purchase. The 18th floor position and water view are still there. The asking price remains in the mid-$400,000 range. Nothing in this investigation proves the building is unsafe, underfunded, uninsured, or facing a specific assessment. But the apartment can no longer be evaluated as an isolated product. First, there is the visible price of the unit. Then, roughly $15,600 a year in association fees. Finally, there is the building-wide exposure that still has to be verified. Capital needs, insurance structure, shared obligations, operating rules, and the ways those obligations can reach the owner. The final test is broader than whether the buyer can afford the monthly fee. Does the full ownership package still make sense after the shared obligations and possible owner exposure are verified? That is the difference between buying an apartment and understanding what comes with ownership. Before buying a condo in Miami, do not stop at the unit. Investigate the system you are joining. If this kind of property risk breakdown helps you think more clearly before buying, you can support the channel by liking the video, sharing it with someone evaluating real estate, or leaving a comment with the type of property risk you want to see next. It helps the channel grow and tells YouTube that serious property due diligence matters.